So the idea of you making a lot of money, is the idea of you making a lot of money to make it and blow it, or make it to become financially free and financially independent? So reflect. How much money has been robbed from you because you've borrowed it or needed from somebody else, some other person? Think about the last 10 decisions you've had to make. You guys got it? Last 10 decisions you had to make. How have they been related to money? Some people left their homes this morning wondering whether or not they had enough gas in the tank. So I did a WAKA FLOCKA video on $2 to $3 million he's put inside a life insurance policy. So people say that's unreasonable, that's too much money. Who's gonna have $2 to $3 million? Okay, well here's another little bit more reasonable one. An engineer, 26 years old, works on the East Coast. He wants to put $2,000 a month into his policy. Why? Because he wants to be a future real estate investor. So the original capital that you got it from though is where? Saving inside your policy. So you got nothing leaving it. You got zero interest leaving the capital, you got zero interest leaving American Express, you got zero interest leaving an XYZ bank, and that's how you get rich off your insurance policy. It's just a different perspective of how you see money. My topic with you this morning, he talked about insurance, I'm talking about Index Universal Life this morning. How would you like to make sure that you never pay interest to anybody else ever again for the rest of your life? Yes. So in other words, interest is coming back to you. Okay, let me break this down real quick. Here's some stats, okay? Here's some stats. National debt. Let's look at national debt. Speaking of national debt, what is the national debt of the United States of America? Where are we at currently?
100 trillion.
We're at $28 trillion, right? Just so you know, when I first entered the insurance industry in 1999, we're at $2, $3, $4 trillion.
Oh my gosh.
And by the way, is trillion a vast amount of money? Yes. Sometimes people hear millions and billions and trillions like it's nothing. Trillion is a vast amount of money. If you just count, okay, right now I want you to start counting to 1, 2, 3, count to a million.
It would take 11 days.
There you go. Take 11 days, right, Micah? 11 days. How much to a billion? A billion. It's 1,000 million. 33 years. To a billion. What about a trillion?
2,700 years. $1 million a day.
Think about it. So when we're talking about $28 trillion in national debt, it's a vast amount of money. Do you think that these stimulus plans are probably added to this national debt? Do you think that giving people forgiveness under student loan debt will add to this number? Do you think that if we create a universal basic income for everybody to get a government check every month, guaranteed if you're an American citizen, that this will add to the national debt? And what do you think? If it adds to the debt, guess what happens to the value of your money? It's less and less and less. So more of your money is spent to other people. Let me give you an example. How much money do you think the country is in terms of car loans? You put all the Americans together, how much total car loans do you think we all have as a country? Okay, everybody, right? You don't need to raise your hand, right? But car loans, how many cars have you owned in your life? Right, 1, 2, 3, 4, right? Okay. Total car loans right now is at 2021, 1.3 trillion. Okay, 1.3 trillion. So student loans, what's the total student loan debt? Okay, you guys are Googling it with me, good. 1.75 trillion. By the way, student loans for everybody in America, or is it just people that go to college? So the small sector of people that go to college, guess what, 1.75 trillion. Do you think more people have car loans than student loans? Of course, more people have car loans. They're just a smaller amount as compared to student loans. But look at the vast amount of student loans we have. It's a small section of the population goes to college. Okay. Credit cards. It's not as much. 787 billion. It's not a trillion yet. Okay. The average debt of somebody in America in credit card is $6,194 per person. Average debt. The thing is, I don't want you to have the mindset, if you're going to really learn the money game, I want you to stop having your money serve other people. Wow. Have it serve you. Because this is what's going on in America. People got money out for car loans, student loans, credit cards. This is lost opportunity. Think about how much interest is being lost. So here's some questions I want you to ask yourself. Write these down. You guys ready? Yeah. Here we go. How many of you guys taking notes? Note takers are history makers. Right, Nicole? All right. Number one, how much money are you losing by borrowing? What was that question? Good. Number 2. Who's making money on my money? Who's really making money on my money? What was that question? Good. Last question. Where should my money go? What's that question? Okay. Let me give you an example. The reason why we're training on these subjects right now, because I don't know if the market that we're about to face right now, the pending looming recession, I don't know if it's going to hit, but when it does hit, okay, let me ask you a better question. Let me have a more generic question. Do you think our country is due for a recession? Yes. It cyclically happens in our country every 5 to 8 years. We haven't had one in 12. And it's been the economy has been artificially propped up because of COVID and stimulus plans. So in other words, a lot of fake companies are wealthy today. A lot of people out there with fake money are about to be exposed. So the idea of you making a lot of money is the idea of you making a lot of money to make it and blow it, or make it to become financially free and financially independent. So reflect. How much money has been robbed from you because you've borrowed it or needed from somebody else, some other person? Think about the last 10 decisions you've had to make. You guys got it? Last 10 decisions you had to make. How have they been related to money? Some people left their homes this morning wondering whether or not they have enough gas in the tank. Because here's what's going on, right? $5.6 trillion, into a record-breaking increase because more people are borrowing. So in other words, $4 trillion of money was printed. Guess what the banks did though? Hey consumers, we got more money to lend out. Come and get it. And consumers fell for it. So we've been doing a lot of reels. We've been doing a lot of social. How many of you guys have been consistent with your content? Yeah? Good. More power to you guys. All right. So we got somebody that asked for an illustration. Young guy, he's an engineer. And he says, I want to put $2,000 a month. So I did a WAKA FLOCKA video on $2 to $3 million he's put inside a life insurance policy. So people say that's unreasonable, that's too much money. Who's going to have $2 to $3 million? Okay, well here's another little bit more reasonable. An engineer, 26 years old, works on the East Coast. He wants to put $2,000 a month into his policy. Why? Because he wants to be a future real estate investor. So this is a pretty interesting fact here. So he puts $2,000 a month into it. He only gets $774,000 in death benefit. But look what the IR total net death benefit is. What does that mean? If you look at this illustration, what's a 3,000% return? In other words, he puts $24,000 into the policy. He dies. The family gets $774,000 death benefit. Kind of neat, right? So he doesn't have this right now. So if he puts $2,000 into this today, automatically something happens to him, and he was found to be healthy, and the application had no fudges on it. His family, his beneficiary, will receive $774,000 check. So why is the interest, the net return on insurance policy the greatest in the early years? Because whose money are you leveraging? And so the insurance company has the most risk at the beginning of the policy. Okay? They have the most risk. So you put $24,000 into the policy, you put $2,000 into the policy month one, something happens to $774 is paid out. Over time, what do you want to accumulate though? Do you want to accumulate more death benefit, or do you want to accumulate more cash? Because cash is what your capital is for your bank. So when people look at the be your own bank strategy with using life insurance, they think about this as a checking account. It's not. You have to capitalize it. Write the word down, capitalize. You have to capitalize. You have to capitalize your bank. How do you capitalize it? The more cash you got going in the early years, the faster it gets capitalized. Why do we want you to make a lot of money? So you can be financially free and capitalize. Do we want you to upgrade your lifestyle? Yes, but smartly. Like we want to show you how to borrow money smartly to travel, to get the right house, to buy the car that you want, but smartly. Let's go fast forward. 5 years from now. He's put $24,000. So inside his policy, look, by the way, this is a whole life. But even with the whole life, look how attractive it is though. So he capitalized his own money. How much money can he take out of his policy? How much money can he take out of his policy in year one? $18,000. So now does he take it out, withdrawal? So there's 3 ways to take money out. The sad way, the smart way, the dumb way. What's the sad way? You die. All right, that's okay. What's the dumb way? You withdraw. You don't withdraw money from a life insurance policy. This is not a bank account, even though it is conceptually your own bank, right? But what's the smart way to pull the money out? You loan. Okay, so you loan. Now here's the thing inside all life insurance policies that have a permanent permanent policy have they call loan provisions. Okay, loan provisions. Okay, so let's say in this example, let's say 10 years, he's got $277,000. You got $277,000 in cash. When you loan it from the life insurance policy, for example, if you have an IUL and it's inside the S&P 500, for example, in a 401k, if you want $200,000 from your 401k, you got $277 in your 401k, you want 200 grand from your 401k. Do you sell your position in the stock market that day to get your cash? Yes or no? Yes. So whatever the stock market did that day, the stock market up or down, they can sell enough shares that you own to get you a check for 200 grand. Okay? Now inside a 401k, if you loan against it, you can always put it back. But if you don't put it back, guess what you have to pay? Penalties and taxes. And if you're under 59.5, you have to pay the penalty, the tax and fees. Income tax, fees, and penalties. All three of those things. Now, that's inside a 401k. What about a life insurance policy using a loan provision? So what they do is they loan you amount, this is now collateral. For example, you have a car loan. You have a mortgage. What's collateral? The car. The home, that's collateral. It's a titled asset, okay? So here, the collateral is your cash value plus your death benefit. So you loan money, not withdraw, right? Yes. Let's say you loan $200,000. Are you selling your money at the current market position it is that day? No. Yes or no? No. No, you're not. By the way, I asked this about a bunch of life insurance agents. They say, yeah, you got to sell whatever the market is doing that day. It's not a 401k, bro. You're loaning it from the... So in other words, you're not selling anything. You're loaning from the policy, in this case, $200,000. Well, Matt, why do I got to borrow my own money? Well, it's a little play on terms. Because in most permanent life policies, they charge you 5%, but at the end of the year, they also credit you what you borrowed. So whatever you borrowed, the interest, they credit you at the end of the year, creating a zero cost wash loan. So in other words, it doesn't cost you anything to borrow your own damn money. Right? So there it is. So now you take that $200,000, you buy a business, you flip a house and property, you buy a house for $250, all right? You buy a house for $250. You got some the cash and capital. We talk about credit cards, and you sell it for $500,000. Right? So here's an example. People are going to be distressed in the next 24, 36 months. Yes? Is that what happened in 08, 09? Yes. Distressed property, meaning people want to sell it no matter what. Yes. So you buy a $250,000 house for $200,000. You fix it up. You get it ready to go back to market. Then you sell it for $500,000. That $250,000. Of the $250,000, that 200 grand, you put it back where? Back in the policy. Right? Put it back in the policy. The other 50K? Hey, babe, you want to eat at that restaurant where there's no prices on the menu? Twice? Twice. Another opportunity comes up. Hey, let's take another $200,000 out. Let's flip a property. Let's buy a business. Let's buy a baseball card. Let's flip it. Sell it. The profits we keep, we put the money back into the policy. How many guys have actually borrowed money from your policy already? Okay, right. Isn't it fast? So think about this. This guy for 15 years, this guy's 27, he's in his 40s. He's got $485,000 in his policy. And by the way, this is not a very attractive policy. It's a whole life policy. But this is what he's showing. This is what we're competing against. Because he didn't have a IUL policy. So this $485,000 policy, guess what now? Same thing. So, in a week or two, a new toy will be delivered here. that Shane and I acquired. This little toy that we acquired, guess where we used the money to get it?
Insurance.
Our insurance policy. And guess how much interest we're paying out? Zero. Okay? Now, the downside to it is what? No monthly deduction. But we're acquiring the car under our business name that our personal policy is paid for. Now we're putting this car in service inside a corporation. Exactly. So in other words, let's say you're okay. Let's say I have a personal car, right? Whatever car you're driving right now. The moment you start a business, now you put in service a personal asset that you're now using for business. Because you start using it for business, let's say 50% of your car driving is business purpose. Okay? Well, 50% of your expense on operating that car is now tax. So the original capital that you got it from, though, is where? Saving inside your policy. So you got nothing leaving it. You got zero interest leaving the capital, and you got zero interest leaving American Express, you got zero interest leaving an XYZ bank, but everything is going to, what's the name you wrote? Which bank on your notes? Everything now, all the interest now is going back to Gomez Bank.
Let's go.
And that's how you get rich off your insurance policy. It's just a different perspective of how you see money. Now here's the thing. Here's the difference between actual clients that are actually using this. There's the naysayers in the competition that say this, and then there's the news that say this, and in between there's confusion. You're supposed, you, the licensed agent, you're supposed to be able to cut the confusion and show them reality. That's what you're supposed to be doing on a monthly basis. And when you do that, guess what happens? You get rich.